Okay, so let me just recap what I just said. For those who can't be here, this is the last time we're going to meet in person. Um, on Friday of this week, from Friday of this week until Friday of next week, which I believe is May the 8th. Yes. So from May the 1st until May the 8th, the last test will be available for you guys to take. You do have to take it in one sitting, but you can take it at any time, okay, between the 1st of May and the 8th of May. Okay. It will cover chapters 9, 11, 12, and 13, which we're going to cover tonight. Okay. Um, if you guys have any questions about that, please let me know now, or you can reach out to me via text or Canvas message, whichever works best. Okay, hearing none, I'm assuming none, so we will dive into the material for tonight, the last of our in-person material. It's kind of exciting. It has been a really weird semester with, the technical issues and stuff like that. So, but you guys have done absolutely great. Let me share my screen with you. Okay. And pull up the slides. This thing is so chunky, it always gets in the way. Okay. Can you guys see my slides okay? Great. Um, Tonight we're going to be talking about stockholders' equity. Let me move this out of the way as well. There we go. All right. So, as is the way with your text, remember at the beginning of the semester, we dumped a whole bunch of information on you, and then we go back and kind of fill in the gaps. So, a lot of this will be a review. So, just kind of hang in there with me. I'll breeze through some items that you've seen already and kind of focus on the stuff that's new. Okay. So, remember, um, I think maybe the first week or the second week, we talked about a corporation. We talked about the different types of businesses you could have, and one of those was a corporation. It is a business that's organized under state law. It's a separate legal entity. It pays taxes on its own. Most large businesses are corporations. Um, they can have a whole bunch of owners. Anybody who buys stock in the company is a partial owner. Remember that companies do not, the owners of the company do not have liability for the company's wrongdoing because the company is a separate legal entity. It's treated like a person. Okay. Um, it has an indefinite life. Okay, the board members can be switched out. People can sell off their stock. Owners come and go, but the company persists. All right, it pays taxes just like an individual, and it's allowed to accumulate capital. Um, so the upside is that corporations can raise more money than sole proprietorship. Remember, that's like your mom and pop shop, your aunt's Etsy store, right? Or the partnership that is your doctor's office or your accountant firm. Okay. A corporation has a continuous life. If the members, the owners die, remember in a partnership, the partnership falls apart. Okay. It's easy to transfer ownership of the business. There's no mutual agency among the stockholders in the corporation. So if you own stock in a company, you are not, You don't share your assets with that company. You're not liable for any wrongdoing that it does. So the disadvantage is that ownership and management are often completely separate. Okay. So you as a stockholder don't get to make the decisions for the company, right? Um, and a lot of times, your board members, the CEO, he's not an owner, right? All right. So there's double taxation there because the earnings are distributed as um, to the owners, right? And there's taxation on those dividends that the owners get, but then there's also taxes that the company itself has to pay. So those resources are taxed twice. Okay. There is a lot of government regulation when it comes to corporations, and the startup costs can be quite high. Okay. So it's difficult to get into that big business space. All right. So, but that's enough about companies. Let's get into the actual equity. That's what this class is about. Okay. So, the maximum number of shares that a company is authorized to issue is called the authorized stock. All right. Issued stock is the stuff that they've already issued, it's already out there and owned by people. And then any stock that's held by the stockholders is called outstanding stock. And the actual physical, it's very rare to see these days because most of this is carried out digitally. But the actual physical stock is called a stock certificate. And capital stock represents a stockholder's ownership. Okay, so this is what a stock certificate looks like. It has the name of the company on it, the name of the person who owns the stock, and the number of shares that they've held. Again, you've only very rarely see these. I know the Treasury Department still issues Treasury bonds in this form, but I can't think of anyone who issues their stock this way anymore. Okay, so here are the different categories of stock. It's just words and pictures. We've already gone through these already. There's authorized and issued that is outstanding. Okay. That's owned by the stockholders. Then there's authorized and issued stock that has been issued but is on the market ready to be sold. And then there's authorized stocks that have been authorized but maybe haven't been issued yet. Okay. All right. So, as a stockholder, when you buy stock in a company, you have four basic rights. All right. You get to vote. Each share that you own represents one vote, and you can elect the board. And sometimes there are other decisions that they put to the vote for shareholders. You don't have to show up in person. They will send out a circular to you and you just check the boxes and mail it back to them. Dividends. So if the company declares dividends as a shareholder, you get a portion of those relative to the number of stock that you have. In the event of liquidation, if the company fails and the assets are sold off, you get a proportionate share of that company's assets. You're one of the owners of that company. And then preemptive rights, you have the right to maintain your proportion of ownership. So if you own a quarter of the shares, that gives you a lot of power in the decision making for that company. Okay. And you have the right to maintain that level of power within the company. Um, also be aware that there are two different types of stock. There's the common stock, which is, you're buying part ownership in that company. And then there's preferred stock, which is kind of like a cross between a stock and a bond. Okay. It's more like a loan that you're giving the company because with preferred stock, you don't get voting rights. Anyway, so stock can carry a par value. That's the value, on the face of the stock, or it can be no par stock. All right. Um, Stated value stock is going to be a no par stock that has been assigned an amount that's similar to a par value, okay, but is not a par value. Okay. The corporation's equity is referred to as stockholders' equity. Remember, that's part of our accounting equation, right? Those assets equal liabilities plus equity, all right? Equity comes from two sources. There's paid in capital. That's money that the owners have put into the company. Okay. With a corporation, generally that's received from the stockholders. All right. And then retained earnings is what you get at the end of your income statement. Remember, that's your income. And you can decide whether to hang on to that income or distribute it as dividends. Whatever part you don't distribute as dividends is retained. So it's your retained earnings and it goes into your equity pile. Okay, so companies use their stock to raise capital. Okay. A company can sell its stock directly to the stockholders, okay? Or it can use an underwriter to sell for them, all right? If you're a publicly traded company, then your stocks are traded on a public stock exchange. There's the New York Stock Exchange, the NASDAQ. There are a lot of different places where your stocks can be sold, okay? And the issue price is the amount that a corporation receives from issuing the stock. Okay. So you got all of that background information so we can dive into how to actually do these journal entries. Okay. So Smart Touch Learning, their common stock carries a par value of $1 per share. And the charter authorizes $20 million or 20 million shares, I'm sorry, of stock. The stock issuance of 15,000 shares of stock at par value is recorded as follows. Okay, so they're authorized to have 20 million shares out. But right now, they're only issuing 15,000, okay, at $1 a piece. So when they're sold, they have cash of $15,000, okay, and then common stock, $1 par value, okay, at 15,000 shares is a credit for 15,000, okay? So in a lot of these, we have seen that we increase, an asset and then we increase an equity account like revenue or expenses. In this case, our equity account is common stock. Okay. All right. So let's say we're getting more than our par value. Okay. If we're issuing our stock above par value, we call that a premium, very similar to our bonds, right? So Smart Touch Learning issues an additional 3,000 shares for $5 a share. The $4 difference between the issue price and the par value is a premium, and it's recorded as paid in capital, excess of par. Okay, so that's just what we call the account. All right, so we know that we got $15,000 in cash. Okay, our common stock at $1 par value is $3,000. And then our plug figure is our paid-in capital in excess of par. Okay? It sounds like a bunch of accounting jargon, but really it's just what they paid us extra for our stock. And we just have to put it in a separate line item account than our stock equity account. Okay, so here is our balance sheet. When we go down to stockholders' equity, we have the common stock that we issued. Remember, we issued 15,000 shares, and then we issued 3,000 shares at a premium. So altogether, that's 18,000. Then we have that excess capital that they paid in. They paid us a little extra. So our total paid in capital is $30,000. Retained earnings, that's what we kept of our income for the year. All right, so our total equity is $33,550. Okay, nothing crazy, nothing that we haven't seen before. Okay, all right. So what if there's no par value on this stock? All right, so Smart Touch Learning's common stock is no par. So assume that the company issues 15,000 shares for $1 and then 3,000 for $5. Okay, so the way we do that, we got $15,000 in cash. Then we have common stock, no par value, 15,000. And guess what? When we only sell 3,000 shares, but we sell it for $4 more, it's the same, exactly the same, because there's no par value. You don't need that excess capital account. You can just say, hey, we got cash. We had common stock at no par value, 15,000. Okay, very easy. So here on the balance sheet, all the common stock just gets lumped together, 30,000, retained earnings that came from the income statement, total equity. You get to the same place, okay? It's just that you didn't have any preconceived notions about what this stock was actually going to be worth, okay? Next example, Smart Touch Learning issues 3,000 shares of $1 stated value stock for $5 per share. Accounting for stated value stock is similar to accounting for par value. Okay, so we're just going to treat this, even though we didn't have a par value, we state that it's worth $1. Okay, we sold it for $5. So we're going to call anything extra that we get as this oh, sorry, I was pointing at the wrong thing. Paid in capital in excess of stated value in this case. Okay. All right. So what if you trade your stock for something that's not cash? And this does happen occasionally. So if you've got a company that maybe doesn't have a ton of liquid assets, but their stock is fairly valuable, they might trade their stock for some other asset. Okay, so let's look at the treatment for that. So in this case, Smart Touch Learning receives furniture with a market value of 18,000 in exchange for 5,000 shares of its $1 par common stock. All right. So first of all, we are going to record the stock or the asset received at market value, whichever one is, more cut and dry, easier to determine. All right. So we know that the furniture has a market value of $18,000. We saw it on the price tag. Okay. We bought it with 5,000 shares with a $1 par value. Okay. So the other 13,000 has to be paid in capital in excess of par. Does that make sense? So even though we didn't lay any cash down, this furniture is worth $18,000, but we only gave them $5,000 worth of stock. So the rest of it is going to be this plug figure down here. We treat it just as though it was cash. Okay. So preferred stock, remember that does not come with voting privileges. Okay. Um, so in this case, Smart Touch Learning issues 1,000 shares of its $50 par 6% preferred stock on January 3rd at $55 per share. Okay, so they are guaranteed the 6% return. Okay, so we get cash, $55 per share, 1,000 shares. So we got $55,000 in cash. Our preferred stock has a $50 par value. So we've got an extra $5,000 out there. So where do you think we put that? In paid in capital in excess of par. Um, Then, again, we're going to look at this issuing common stock. Did I? Oh, here we go. So sorry about that. So here is our stockholders' equity on the balance sheet, including our preferred stock right here. Okay, it's worth $50,000. And then we got $5,000 paid in additional, then common stock with paid in capital in excess of par. And then we have our total capital and our retained earnings. Okay. All right. So, treasury stock, that's where we have issued stock to the public and they bought it, and then we bought it back and we're holding that stock within our own company. Why would we do this? Um, it can increase our assets. So, we sold a bunch of stock at a good price, and now the value has gone down, so we're buying that stock back. Okay? And that will possibly create a scarcity that'll cause our stock value to rise. It's also a way to concentrate power within the company. I know, television shows like to use the plot line of a hostile takeover quite frequently. That doesn't happen very often, but if an individual were to accumulate a lot of a company's stock over time, they would become a controlling interest. They would own the majority of the stock and become the majority shareholder. In order to prevent that, companies will often closely hold some of their own stock so that they can uh, maintain control of the organization. So we're buying back this treasury stock, but how are we accounting for it? Okay. Usually it has a debit balance. Okay. It is a contra equity account. All right. Treasury stock is going to be recorded at cost. There's no reference to par value here. Okay. Um, and the treasury stock account is reported underneath the retained earnings as a reduction to overall equity. So we have our paid in capital and whatnot, and our retained earnings. That's all the positive equity. And then our treasury stock is a reduction of equity. Okay, so how do we record that purchase? Smart Touch Learning purchases 1,000 shares of previously issued common stock. They pay $5 per share. All right. So treasury stock, there's a debit for there's a debit for $5,000. That's going to reduce equity, and then there's a credit. So we're going to also reduce cash by $5,000. Okay. So, in this example, Smart Touch Learning sells 100 of the treasury shares in April for $5 each. So we get $500 in cash, and we get some of that equity back. Okay, because we sell off those shares. All right, so what if we sell them? So we bought our treasury stock back. When we sell it back to the public, what if we sell it for more than we bought it for? Okay, in that case, so here we have Smart Touch Learning resells 200 of its treasury shares for $6 per share on April 2nd. Okay, remember they paid $5 a share for it. So cash, they get $1,200. Treasury stock is decreased by $1,000 because that treasury stock was sold, but there's this extra $200 that they received that goes into paid in capital. It's a separate line item, paid in capital from treasury stock transactions. Okay. It's just the terminology we use for getting extra for selling off our treasury stock. All right, so what if we sell off our treasury stock, but we make less money than we bought it for? Okay, so we paid $5 for it, but we sell it back out to the public for $430 each. Okay, 200 shares. So we got $860, but we're reducing the treasury stock by those 200 shares. So we're reducing treasury stock by $1,000. We need this plug figure. It's actually negative paid in capital. So we're reducing our paid in capital account. All right. So what if you resell an additional 200 shares for 450? Okay. Remember, we paid 500 for it initially. So you are going to record the difference to paid in capital. Okay. All right. And then this is what all of those transactions look like on the balance sheet. We're just adding on those additional transactions that we've performed. Just making sure we're good on time. Okay. So again, this is just showing you the difference between authorized and issued, right? So they're authorized for 20 million shares, okay? But they've only issued 23,000, all the rest are unissued. They have outstanding shares, those are the shares people are holding, and then they have the treasury shares, those are the shares that they bought back, okay? All right. You can retire stock by canceling stock certificates. Okay. Any retired stock can't be reissued. All right. If you have to purchase that stock back from the people who are holding it, and then you retire it, you don't hold it in the treasury account. So this retired stock is going to be taken off the books entirely, and it's going to reduce the total assets and the total equity because we have to keep that accounting equation balanced, right? So, let's look at dividends and stock splits, okay? So when your company makes income, you can keep it all in the company and use it to grow the company. Or you can distribute all of it to your shareholders to make your stock look more valuable and have, people really excited about owning your stock. Most companies fall somewhere in between those two choices. They keep some money for themselves, for the company. Okay, they're not paying it directly to themselves. They keep some money in the company to grow the company, and they distribute some of that money to the shareholders in the form of dividends. Okay. Those dividends can take the form of cash, stock, or they can distribute property, which is not very common unless a company is going out of business and they have to liquidate. All right. So legal capital is the portion of stockholders' equity that cannot be used for dividends. Okay, you've got to keep some money in the bank. You can't pay it all out. All right. So when we're talking about dividends, there are three important dates. There is the declaration date. That is the date that the board of directors announces, hey, we are going to issue a dividend. Okay. Then there's the date of record. All right. This is the date that the corporation records the stockholders that will receive the dividends checks. Okay. And then the payment date is the date that the dividend actually goes out to the shareholders. Right. So I tell you all of that because there are different journal entries for the different stages of the dividend. Okay. So on May 1st, Smart Touch Learning declares a 5 cent per share cash dividend on the 22,700 outstanding shares of common stock. All right. So you're going to debit cash dividends. All right. And you're going to create this liability of dividends payable. Now, you've just announced that you're going to pay it. You haven't paid it yet. Okay, so right now it's a liability on your books. Okay, then on May 15th, we make a list of all the people who are getting money. Okay, but no journal entry required. Yay. Then on May 30th, Smart Touch Learning pays the dividend to its shareholders. All right. Then we're going to zero out that dividend payable, that liability that we had, and we're going to reduce our cash because we're actually paying the cash out to our shareholders. Okay. Then at the end of the accounting period, Smart Touch Learning closes the cash dividends account to retained earnings. Okay. So that's a temporary account when we're doing those adjusting journal entries. We want to zero out the cash dividends and reduce our retained earnings by that amount that we've paid out to our shareholders. Okay. So the cash dividend rate on the preferred stock that we paid out is a percentage of the par value. It's 6%. All right. That means anytime that we plan to pay out dividends, we have to pay it to the preferred stock first because they absolutely have to get 6% of the par value anytime that we plan to pay a dividend. Okay. Sometimes preferred stockholders have a flat amount instead of a percentage. So it'll be, like $3 a share, $2 a share, whichever. So here's an example. Greg's Games has 1,000 outstanding shares of 6%, $50 par value preferred stock. The dividend is computed as follows. So you've got 1,000 shares. They're at $50 per share. They're getting 6% of that $50. So $3,000 total is what we're paying out for preferred stock. So dividends in arrear, okay? That is when you owe these. Remember that I said that the preferred stock is more like a loan than an actual controlling interest in the company or an actual, piece of the company. So, if you did not pay a dividend last year, you still owe them that 6%. So you're in arrears with that dividend for those guys. Okay. And then we have two flavors of preferred stock. We have cumulative preferred stock. That's when the owners have to receive all the dividends in arrears plus the current dividends before the company pays anybody else. Okay. So the commoners, the common stockholders don't get anything until all the back payments and the current payments go to the preferred stock. If it's non-cumulative preferred stock, the owners don't receive the past dividends. Okay. So they still get paid first when the company declares a dividend. Okay, they'll get that 6% first, but they don't get the arrears dividends, right? Okay, so Greg's Games has 1,000 outstanding shares of 6%, $50 par value, cumulative preferred stock. Cumulative, that means they get the amount that's in arrears, okay? In 2025, the business did not pay any cash dividends. On September 6, 2026, Greg's Games declares a $50,000 total dividend, okay? So they have $50,000 to give away. They're $3,000 in arrears, okay? Because those preferred stockholders get 6% of that $50 par stock every year, okay? So last year they didn't get their 3,000. This year you owe them 3,000, okay? So we have to pay them that total $6,000, and then we have $44,000 left over to distribute among the commoners, okay? All right. So, we declare the dividend. All right. We're paying $50,000 in cash dividends. Dividends payable to common stock is 44,000. Dividends payable to preferred stock is 6,000. Okay. So we have our liability set up. Then, Greg's Games, 1,000 outstanding shares of 6%, $50 par value, non-cumulative preferred stock. Okay, so we don't have to pay the arrears amount. All right, in that case, we just have the current year. We have to pay that $3,000 for this year, and then the rest can go to the commoners. Okay, all right. So enough about that. Let's talk about stock offerings. All right. So in a stock dividend, this is when you're already a shareholder, but instead of getting cash, you get more stock. Okay. These stock dividends, they affect the stockholder's equity account. All right. They have no effect on the sorry, let me go back. The stockholders' equity account. So the individual stockholders, they don't impact the overall equity of the company. Okay. And they have no effect on assets and liabilities. So essentially, you have a person who bought one share for a certain amount of money. If you pay them more shares, for free, then they have 3 shares, but they only have that amount of money, okay, spread among the shares. Okay, it's not going to affect the company's equity account because they have not really given you anything except more shares in their company. All right, why would a company issue stock dividends instead of cash? It's because they want to be seen to give you something, okay, but they want to conserve the cash, keep it in the company. Also, they may want to dilute their stock for whatever reason. They want to reduce the market price for those shares. Maybe they're planning a buyback, who knows, okay? And also as a reward to their investors, again, to have them feel like they're getting something. All right. 3 dates for this as well: declaration date, record date, and distribution date. Also, we have small stock dividends that is less than 25% of issued and outstanding stock. A large stock dividend is greater than 25% of the issued stock. All right, so what does that look like? Greg's Games distributes a 5% common stock dividend on their 2 million shares issued and outstanding when the market value is $50 per share and par value is $1 per share. Okay, So on the declaration date, all right, stock dividends, they're worth $50 per share on 2 million shares outstanding. At 5%, that's $5 million. Common stock dividend distributable, that's what we're going to call our liability account. That is $1 per share at 2 million shares times 5%. So we are crediting that liability for $100,000, then paid in capital in excess of par is our plug figure that makes up the difference between this common stock distributable and the stock dividend amount. Okay. All right. So on February 25th, Greg's Games distributes the stock. Okay. So then we want to clear out that liability account, and then we want to increase common stock at $1 par value by $100,000. So we have more stock outstanding. Okay. So this is the journal entries that we've discussed as T accounts. Okay. And this is the balance sheet for Greg's Games with the transactions that we have performed up to this point by way of journal entries. Okay, so on March 2nd, Greg's Games declares a second common stock dividend of 50% when the market value of Greg's Games common stock is $50 per share. All right. So cash dividends and stock dividends are always declared based on the number of shares issued and outstanding. Okay, that's just a little extra info. So our stock dividends, $1 per share at 2,100,000 shares. Because remember, we put out 100,000 shares last time at 50%. Okay, so our common stock dividend distributable is 1,050,000. Okay. Then on the 30th, okay, our common stock dividend distributable, we're going to zero that out because we're giving out the stock at that point. We don't need the liability on our books anymore. And then our common stock will increase by 1,050,000. Okay, stock split. This is different from a stock dividend, okay? So when you get a stock dividend, you are given new stocks, okay? A stock split increases the number of issued and outstanding shares of stock, true, but it decreases the par value and the market value per share, whereas stock dividends do not affect the par value per share. So when you do a stock split, you had one stock that was worth $50. Now you have two stocks that are worth $25 each. Okay. That stock just gets split into two. Okay. All right. So if Greg's Games has $3,150,000 shares issued and outstanding at a $1 par value, and then the market value is $50 per share, Greg's Games affects a 2-for-1 stock split. Okay, so each one of your one stock becomes two. Okay, there's no formal journal entry needed. Okay, the split is recorded in a memo. And the entry in the journal notes a significant event, but has no debit or credit amount. Okay, and that will go in the notes to your financial statements. Right? So this table sums up everything that I have said for the last couple of slides about the treatment of cash dividends versus stock dividends versus splits, etc. Do you guys have any questions about anything that I've covered up to this point? Okay, hearing none, I am assuming none. Okay, so here is your income statement. Okay, we're pretty familiar with these by now. Oftentimes, there will be a small breakdown at the bottom that simply divides the total income by the number of shares outstanding in order to calculate a per share earnings. Okay. So the first section here on the income statement is our continuing operations. Okay. That's just our day-to-day corporate business. Okay. The next thing we have is our special items. So in this case, we discontinued item operations for a business segment. Okay, so that's in the special items section. And then we come to net income and we also distribute that as earnings per share. Okay. So discontinued operations, again, that's a business segment or a product line that you've discontinued. Okay. When you discontinue that item, you liquidate any assets associated with it, and you recognize either a gain or a loss. It's just like selling off any other asset. Okay. If you got more back than you intended to while you were, remember that depreciation thing? We have the salvage value at the end. And if that salvage value is more than we thought it was when we sell off that asset, we report it as a gain. Okay. And then earnings per share. That is a business statistic that's often used by investors to see, to decide what companies they would like to invest in. That is the amount of net income for each share of the company's outstanding stock. So you're just dividing the income at the end of the financial statement by the number of shares outstanding. Okay. All right. So there is a separate financial statement called a statement of retained earnings. Okay. It is possible to report a deficit on this financial statement. That is true also for the income statement, right? You can be operating at a loss and have negative income. All right. So our statement of retained earnings is fairly simple. All right. We have our beginning retained earnings. Usually there will be an amount here, unless you are a startup company. All right. Your net income is added to that amount. Any paid in capital, so any additional capital that was paid into your company is added, right? The dividends are subtracted because that's money you gave back to the owners, and whatever's left over is your retained earnings for the year. Okay. And this should also sync up with what you've got on your balance sheet. Okay. So banks will often require that companies maintain a minimum level of stockholders' equity. So those are called appropriations. That's a restriction. and it's recorded in your journal entries, okay, that you have to maintain this minimum amount of equity, okay? Um, Another thing that you might have to deal with is that sometimes companies will make an accounting error. It happens. Okay, we're not talking about fraud here. Okay, this is just misstated. Somebody fat fingered a number. Okay, in this case, when it's not discovered until the next period. So we're in 2026. We realize our 2025 financial statements had a misstatement on them. Okay. If we make a correction for the prior period, we usually adjust that in retained earnings. Okay. So here's an example of a prior period adjustment. Mountain Home Inc. recorded $30,000 of salary expense for 2025, but the correct amount was 40,000. So in 2026, they have to fix that. Okay. Um, so their retained earnings was 140,000. So for the prior year, they have to adjust it by $10,000 because they recorded less in expenses than they should have. Okay. So pretty simple fix there. All right. In the notes to your financial statements, you should probably elaborate on this um, and explain what this adjustment was and why you needed to make it. Okay, that ends the material for tonight and for the course. Are there any questions on anything?
I do have a question.
Yes. Kim?
Um, this is for the homework that was due for today. When I went to do it, it had the same issue as one of the previous assignments where the data was not available. It was not in the instructions. It was not in the regular one. I couldn't find the data, or I was confused about what the data is supposed to be.
Okay, so when you went to do the homework, you received a blank um
It just didn't have like a data sheet at all. It had instructions, enter answer sheet. There was no data sheet. There was no hidden one. And when I looked at it, I was just kind of lost because I didn't see it at all, like
okay.
what the data was supposed to be.
Because, because we're so close to the end on this, I will investigate it, but it's likely. I mean, we have over 60, I mean, I think it's like 66 assignments for the entire course of this.
That's all.
So, I think that I will probably I'm probably just going to excuse that.
Okay.
Okay. Um,
I think it was number 12.
okay. Yeah. So let me ask you. So you were able to get the other items, but just number 12 is wonky. Is that what you're saying?
Just the Excel part. I think it was number 12 Excel. That
Okay.
one just would not it just didn't show anything.
Okay. Have you turned that in already?
No.
Okay. Go ahead and turn that in and yeah, I'll just adjust it accordingly.
Well, there was no data at all. It would just be like an empty. It would be like just the regular spreadsheet with no.
I see,
Um,
I see. I see you're saying it's from chapter 12.
yes, chapter
You were
12.
saying I thought you were saying there's one item that didn't have and I was like, "Oh, okay, well I can just
Oh,
adjust that." But no, no, the whole spreadsheet. Okay,
yeah.
I'm up to speed now. Yeah, I'm just gonna excuse that at this late stage. I don't really
Okay.
think that would um that's going to impact your score that much. Okay.
Yeah.
So, does anybody else have a similar issue or any other issues that you need to bring to my attention?
I had the same problem when I opened it up, the Excel, the last Excel. I'm sorry, I've been sick. Um, it's just had the instruction and the answer. That's it. Nothing